Conventional trading wisdom tells you to set stop losses and take profits. But behavioral finance and empirical data suggest these two habits systematically damage your long-term returns. Prospect theory explains why our instincts are exactly wrong. Examines the evidence and offers a more rational framework. Stop-loss orders are designed to limit losses, but they often do the opposite. When a position drops, our natural instinct is to hold on, hoping for a rebound. This is risk-seeking behavior in the face of losses, as described by prospect theory. A stop-loss forces you to sell at the worst moment, often during a normal market correction. The result is that you lock in a loss and miss the subsequent recovery. The evidence shows that many stocks that eventually rise sharply first experience significant drawdowns. By exiting early, you forfeit the chance to participate in the rebound. Take-profit orders seem prudent, but they cap your upside. Prospect theory shows that when we are in profit, we become risk-averse and want to secure the gain. This is the disposition effect: we sell winners too early and hold losers too long. The cost is significant. Empirical studies show that a large portion of a stock's total return comes from a few exceptional trading days. If you sell after a 20% gain, you might miss a subsequent 200% move. By taking profit, you are systematically cutting your winners short, which is the opposite of what generates superior long-term returns. Prospect theory, developed by Daniel Kahneman and Amos Tversky, describes how people evaluate gains and losses. The value function is steeper for losses than for gains, meaning a loss hurts about twice as much as an equal gain pleases. This asymmetry drives our risk-seeking in losses and risk aversion in gains. The formula shows that the value of a gain of x is x raised to a power, while the value of a loss is a multiple of that. This explains why we hold losers and sell winners. The expected value of a trade is the probability of winning times the average win, minus the probability of losing times the average loss. This is the core of any trading system. Stop-loss and take-profit orders change these parameters. A tight stop-loss reduces the average loss but increases the probability of being stopped out. A take-profit reduces the average win. The key is to design a system where the expected value is positive over many trades. The formula shows that you need a positive expectancy to be profitable in the long run. Instead of relying on stop-losses, professional traders use position sizing to manage risk. The formula determines how much capital to allocate to a trade based on your account size and the risk you are willing to take. The idea is to risk a fixed percentage of your account, not a fixed price level. This way, you can survive losing streaks and let your winners run. The formula shows that position size equals the amount you are willing to risk divided by the difference between your entry price and your stop-loss price. But the stop-loss is not a cognitive trap, it is a risk management tool. The difference is that you are not using it to predict the market, but to define your maximum loss. The traditional approach uses a stop-loss to exit a trade when the price moves against you. The alternative is to use position sizing to ensure that a loss does not exceed a predetermined percentage of your account. The key difference is that a stop-loss is a reactive measure, while position sizing is proactive. With position sizing, you know your maximum loss before you enter the trade, and you do not need to exit based on a price level. This allows you to stay in the trade during normal volatility and only exit when your original thesis is invalidated. Take-profit orders lock in gains at a predetermined price. Trend following, on the other hand, lets profits run until the trend reverses. The evidence is clear: most of the gains come from a few large moves. By taking profit early, you miss those moves. Trend following uses trailing stops or moving averages to exit only when the trend changes. This approach captures the bulk of a trend while accepting that you will give back some profits during pullbacks. The trade-off is between certainty and potential. This chart illustrates the concentration of returns. It shows the cumulative return of a typical stock over a year, with the majority of the gain occurring in a few days. The line rises slowly for most of the year, then spikes sharply on a handful of days. If you had taken profit before those days, you would have missed the bulk of the return. This is why trend following is superior: it stays in the market during those critical days. This table compares the outcomes of different exit strategies over a simulated period. The buy and hold strategy captures the full return. The take-profit strategy sells after a 20% gain and misses the subsequent 200% move. The stop-loss strategy exits during a normal correction and misses the recovery. The trend-following strategy, which uses a trailing stop, captures most of the move. The numbers are illustrative but reflect the general pattern found in empirical research. Here are the key numbers that summarize the argument. The loss aversion coefficient is about 2.25, meaning losses hurt more than twice as much as gains. The disposition effect causes investors to sell winners too early and hold losers too long. And a small number of trading days account for the majority of market gains. These numbers highlight the psychological and empirical basis for the critique of stop-loss and take-profit. But without a stop-loss, I could lose everything. Position sizing limits your loss to a fixed percentage of your account. I like to take profit to lock in gains. But you are missing the big moves that drive returns. How do I know when to exit? Use trend following, exit when the trend reverses, not at a predetermined price. In summary, stop-loss and take-profit orders are cognitive traps that exploit our natural biases. Prospect theory shows that we are risk-seeking in losses and risk-averse in gains, leading us to sell winners too early and hold losers too long. The empirical evidence confirms that most gains come from a few exceptional days, so cutting winners short is costly. The alternative is to use position sizing to manage risk and trend following to let profits run. This approach aligns with rational decision-making and improves long-term returns. We value your feedback and look forward to bringing you more evidence-based insights. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.